Interest rates have been falling, but what if these are the lowest that rates are going to get, and in fact, rates will rise from here? Currently, there are a number of emerging pressures that could cause inflation and interest rates to rise again. So in this video, we'll look at reasons why that might happen, both in the US and in the UK. And if so, what should you do about it? And if you do like our content, don't forget to like this video and subscribe to our channel. Now I'll start off talking about US interest rates because generally when US rates rise, it pushes up rates elsewhere, including in the UK. So what are the reasons why US rates might rise? It's clear that the stock market reaction to President Trump's victory in the election in the US has been euphoric. And for example, if we listen to what Cathie Wood says, who's a cheerleader for US growth stocks, she points to deregulation, government spending cuts, tax cuts, and a focus on technologically enabled innovation. And she thinks that could turbocharge growth in the US economy to what we saw during Reagan's era. So why is that a problem? Well, the problem is actually one of overheating. Trump is coming into office with talk about stimulus, but in fact the US economy is doing pretty well, certainly compared to other developed markets. So if you layer on top another level of stimulus on an already okay economy, it could lead to overheating. So in this interview with Dan Iverson, CIO of PIMCO, which manages $2 trillion of money and knows a lot about bonds, he says you've got to be careful what you wish for. He said there's some risk that some of this exuberance can work its way back into both inflationary expectations or actual inflation. Now remember that if there's inflation, the Federal Reserve would have to raise interest rates again. So this is really not going to be good for bonds and potentially for US risk assets. And certainly looking at US valuations right now, they are in a state of euphoria. With a forward price to earnings multiple of around 21 times, we're roughly where we were at the post-pandemic euphoria and not too far off where we were with the dot-com bubble. So I'd certainly say that risk assets in America could suffer if inflation spikes and we get another round of higher interest rates from the Fed. Now we don't know what Trump's policies will be in detail, but we know the broad outlines based on what he's said so far in speeches, and one of those policies is tariffs. Now the reason why that's inflationary is that the companies which are importing goods from abroad have to pay those taxes. That can often get passed on to consumers and that increases prices. So this is directly inflationary for US citizens. Another policy which he'd like to implement is to cut taxes. Now that is also an inflationary choice. If you put more money in people's pockets and also on corporate balance sheets, that tends to stimulate the economy and it's inflationary. Another policy is mass deportations of illegal immigrants. Now that could be a problem in particular industries like agriculture because you have to substitute other workers to do the same job for more money. If this does lead to inflation, the greater worry I'd say is that at that point that Trump will blame the Fed because the Fed will be forced to raise interest rates to combat this higher inflation, and that of course will cool down the economy. Plus it could reduce stock prices, all of which Trump wouldn't like. If at that point he decides to step in and meddle with the Fed and reduce its independence, that could be a huge problem as seen by bond markets. And it could well bring in the bond vigilantes, which would sell US treasuries and push up yields. Now each of these items on their own would push up US yields, particularly at the long end of the curve, because yields there are driven by inflation expectations as well as growth expectations. So higher inflation means higher yields, means a bond sell-off. And if we combine all of the factors, we could be looking at a sizable increase in yield. Now, if you're one of our premium website members, you get to monitor all sorts of macroeconomic variables, which I'm discussing in this video, for example. So let's take a look at the macroeconomic tracker. For example, you can monitor the US jobs market, you can look at non-farm payrolls, or if you're interested in buying bonds, we've got the UK yield curve. And this is the shape of the yield curve, including all of the UK gilts. You can even look at what's priced into inflation-linked gilts to see what markets expect inflation will be in the years ahead. And what's interesting here is that the 5-year, the 10-year and the 20-year break-evens are all above 3%, well above the Bank of England's target. So now let's turn to the UK. Now, apart from the fact that if US yields rise, UK yields would follow, very likely, if you listen to what the Bank of England said in its November 2024 monetary policy report, their central case is that bank rate will fall to around 3.6% by the end of 2027. So even in their central case, we're not going to get rates falling a lot from where we are today. But as I say, that's just their central case. The Bank of England's current framework is to consider three scenarios. Think of them as how severe monetary policy will be. Scenario 1 at the top, I'd characterise as we did it. Essentially, inflation is now quashed and there's not going to be a lot more pain and rates can come down quite soon. In fact, we've already started cutting rates in the UK. Scenario 2 is that central case where a little bit of pain is going to be required to finish the job and get inflation back to 2%. Scenario 3, however, is the one I'll focus on, which is the much more problematic case where inflation is very sticky indeed and requires rates to remain high for a long period of time or potentially be raised from where they are today. The reason behind that stickiness is psychological because businesses and people expect their wages to stay high, they want their income to stay high in order to compensate for losses which they've made during the period of high inflation. In fact, people now have anchored at a higher rate of wage growth or income growth if they're companies. That in turn could be very inflationary. And it'll take a prolonged period of high rates in order to reverse that psychological change, that structural change, as the Bank of England calls it. Now, there's evidence for this stickiness in the monetary policy report, such as this graph, which shows the frequency of price changes. During a period of high inflation, it's often these frequency of changes which matters more than their magnitude. So the blue line here is service inflation. And remember that most of the UK economy is driven by services. And certainly if you break it down item by item and look at the frequency of increase of prices, then you can see services inflation still remains very high. And the amount of disinflation, which is how much the rate of inflation is falling, is fairly limited so far. So that certainly looks sticky to me. Now, this is the Decision Maker Panel Survey, or DMP survey, where the Bank of England asked chief financial officers from small, medium and large UK businesses about what they think about the economy. And here's their view about wage growth. Now, for the overall survey, you can see that the expectations are for 4% wage growth, which isn't too far above the Bank of England's target 2% inflation. But look at the consumer-facing services sector. There the expectation is that wage growth is going to be in the region of 4.75%. That's way above what you'd expect for companies which produce goods, where it's only 3.75% wage growth. So this is a forward-looking measure, I'd say, of services inflation. If wages are growing, that feeds through to higher services inflation, and that could keep inflation higher for much longer, in line with the third scenario from the Bank of England. The bank also notes that the increase in national insurance contributions from companies may also affect wage growth, in other words, push it upwards. And if we look at the effect of that budget on inflation, according to the Office for Budget Responsibility, they also forecast that it'll push up inflation in the mid-term. Not hugely, but certainly by a significant amount. So you can see that all of these factors point to services inflation remaining sticky, as it has been so far. If you split UK inflation into services and goods, goods are already in deflation, prices are falling year on year, whereas for services, we're still seeing very rapid growth in prices. And if wage growth in the services sector stays high, then inflation's likely to stay high as well. Now, of course, this is not taking into account another spike in energy prices due to geopolitical instability. That's always a risk, of course. Now, you saw our trackers previously, which allow you to monitor macroeconomic variables. We're also really excited to announce the launch of our PensionCraft Tools app, which allows you to take an investment strategy and backtest it. Furthermore, you can also simulate the future with Monte Carlo simulation. Now, all of our premium website members get access to that app. And we haven't increased the cost of our subscription since 2021, but we will be raising it in the new year. So if you want to lock in that low subscription rate and get access to our trackers, our app, and of course our chat application, so you can ask a question whenever you want, just go to our website, pensioncraft.com/membership to learn more. So what would higher rates mean for you? Well, it really depends whether you're a saver or a borrower. If you're a saver, then maybe you want to keep your money in money markets right now, and that's because bank rate is unlikely to fall by much and it may start to increase again. By delaying your switch into gilts and extending your duration later, you may be able to buy bonds at higher yields than you'd get them today. On the other hand, if you're a UK borrower, then perhaps you don't want to delay refinancing your mortgage if you think rates are going to be increasing in the near future. Or if you're a first-time buyer, you wouldn't put off buying a house waiting for interest rates to come down, because if they're going to go up, there's no benefit in delaying. Now, this isn't a forecast, of course, I don't make those, but I hope I've given you some ideas about why the conventional thinking currently is that rates will fall. But in fact, I'd say there are some fairly likely paths to rates increasing over the medium term. And that would affect markets, it would affect fixed income, it would affect equity, and it could affect your choices about whether to buy a house or refinance your mortgage. Now, don't forget, if you do decide to join our community, you will be able to do that at a currently low price, not inflation adjusted, and you can learn more about that by going to our website, pensioncraft.com/membership. And that way you can avoid any price increases which we introduce in the new year. And, as always, thank you for listening.